My name is Garth Mackenzie, and I'm an ETF strategist and technical analyst with Traders Corner. This week, we're going to take a look at the S&P 500 on a slightly bigger picture view. We're going to look at a weekly chart as well as a monthly chart of the S&P 500, and then bring it back and look at two possible ETFs. They're actually inverse ETFs that we could look to trade for a possible correction in the market looking out to the end of the first quarter and maybe into the second quarter of this year. The first chart that I'd like to bring your attention to is the weekly chart of the S&P 500. Now, what's quite interesting to note here is that the market saw a massive big gap down at the start of this week, and you can see that quite clearly illustrated on this chart. That gap is significant for its size, and also the fact that it comes after the market had been illustrating negative divergence on both the relative strength index and on the stochastic oscillator. Those negative divergences indicate that the market is not being confirmed with its move to the upside. In other words, the participation to the upside is somewhat dwindling, and it very often precedes a pullback in the market, and that's exactly what we've seen here now. Yesterday's big drop on the S&P 500 saw the market trade down to 3215, and that's a significant lateral support level. Now, what I think is going to be quite critical in the weeks ahead is to watch that 3215 lateral support level, because if that does break to the downside, then I think there's a chance that we may actually see further weakness towards the 3000 area on the S&P 500. Now, if we move forward to my next chart, this is a much bigger picture chart. This is actually a monthly chart that we're looking at here. And the reason I bring this up is because in the month of January, we saw a shooting star candle form, and that's very often an indication of a top. What's quite interesting to note is that with the month of February now drawing to a close, it's looking as if we might be building a second shooting star candle. Now, obviously, it's a bit early in the day to be saying this. The week is not yet finished. We've still got to trade out to the end of February, and there's a couple of days left in the market trading this week. But for the time being, I think it's going to take some doing for the market to actually undo that shooting star candle that we seem to be forming for the month of February now. And what's quite significant is that this massive monthly reversal, the second consecutive monthly reversal, comes about as the fears of coronavirus spreading more globally seem to be coming to the fore. And the market was previously a little bit complacent about the coronavirus and the effects on the global economy, I thought. But it now appears as if these markets are actually starting to price in the supply chain disruptions and the slowdown that we're seeing in economic growth due to the coronavirus. So if we are starting to see a repricing of risk assets, as it appears to be the case here, then I think one might expect that there's a potential for still a little bit further pulling back on these S&P 500 index. Now, if we take a look at my next chart, this is the SH, it's the ProShares Short S&P 500 ETF. And I've alluded to this previously. It's an inverse ETF that basically trades inversely to the S&P 500. What's interesting here is that this ETF has actually broken that steep downtrend that has been evident since October of last year. And that, to me, begins to set up the possibility that you might find this ETF actually moving higher. That red line there comes through at about $24 per share. And I suspect that we might be in the early stages of forming an inverted head and shoulders pattern here that ultimately might see this ETF breaking higher through that red line and heading up towards $25 and maybe even $25.50 per share. Now, my next chart is for those that have a slightly higher appetite for risk, and this is the ProShares Ultra Short S&P 500 ETF. The reason I say it's for those with slightly higher appetite for risk is because it's a leveraged ETF. This one provides you with 2 times leverage on the movement of the S&P 500, and it's also an inverse ETF. Again, what you can see here is that the downtrend has been broken quite clearly, and I suspect that this is now the early stages of the market beginning to make a move above that downward trend and actually ultimately form the right shoulder of an inverted head and shoulders and then head up higher. So any dip, I think, towards $24 a share here, one could possibly start looking at buying this ETF. And then I think we're going to go up to $26, maybe $27 per share on the upside. So that's it, some ETFs to look at this week, and I'll be back with you again with more market analysis and a look at some other ETFs next time.